Hey, good morning, everybody. It's Michael St. Clair with Freedom Equity Group, and I want to say first off, happy St. Patrick's Day to everybody. Thank you for taking some time out of your Saturday to join us here on the Builders IUL University. This is going to be a fantastic university. We have a great lineup ahead of you. So with all that being said, we're not going to waste any time. I'm going to turn the call over to our CEO, Ron Petrinovich. Petro, the floor is yours, sir. Take it away.
Okay. Thank you, Michael. Hey, good morning, everybody. The IUL University is backed by popular demand, and I love doing them. I'm passionate about it. So thanks for spending your time with us today. My goal is to help you become a black belt at Index Universal Life. And once you do, you got a chance to make a whole bunch of money. Before we turn it over to our first speaker, Steve Little, I want to say a couple things. This is our chance, and this is your chance to change the largest industry in the world. Believe me, this is an absolute revolution. It's a revolution with living benefits, the new kind of life insurance you don't have to die to use. It's a revolution with tax-free income. 50 million Americans still put money in the dum-dum plan, which I call the 401k, fully taxable at retirement, money fully at risk, getting raped with fees. Revolution number 2, tax-free retirement plan. And revolution number 3, and this is where all of us come in, is there's a revolution going on in the way life insurance and retirement products are distributed. The traditional insurance agency model is dead, and it's been replaced with our kind of model where you can build yourself, not only go out and sell, but you can build an agency. So, a couple of recommendations for you. What do you got to do? What do you got to do to get good at this? So here's what I think you need to do. Number 1, you got to be good at selling these products and make money. Nobody follows broke people. Number 2, once you're good, you're a copy where you're worth duplicating. So learn, get good at it yourself, and then teach it to others. That's going to give you income security. Number 3, eventually you need to develop into a leader. Leaders aren't born, leaders are developed. You need to work on your leadership skills, read the right books, self-help type stuff. Have your goals written down. People follow people that know where they're going. That's going to be a leader and build a big income. You got to be believable. People got to know that you're on your way to doing something. And then number 4, if you want to become financially independent, it goes beyond you being a leader. You need to go out there and build leaders. And guys and gals, if you do that, we're in the largest industry in the world. We need brick and mortar offices, 20 to 50 of them, in every city across America. And you're never going to find a business opportunity bigger than the one you got right now. So, with all that said, I'd like to, Michael, by the way, Michael, you can start setting up Steve, but Steve, don't push the button until I'm done here. I ran into this article the other day, 13 reasons why your 401k is your riskiest / stupidest investment. Number 1, you can be wiped out overnight. What kind of retirement plan allows people to lose 30, 50% of their savings? Do you think the market will ever crash again? Yes, it will. We just don't know when. Number 2, administrative fees and the tyranny of compounding costs. A 2% fee takes half your retirement away. That's dumb. That's why I call it the dum-dum plan. Okay, next. By the way, one of the most famous mutual fund guys says, do you really want to invest in a system where you put up 100% of the capital You take 100% of the risk and you only get 30% of the return? Dumb. Okay, next. No liquidity, no cash for other opportunities. Lack of liquidity when you need it most. Lack of knowledge encourages unconscious investing. Ask the average person, you got a 401k? Yeah. Where is it? How's it work? Is your money at risk? Okay, you get it, right? Number 6, fear of taxes leads to underutilization. You get a tax deferral today, but you're going to pay taxes later, right? Probably in a higher tax bracket. 20 trillion in debt, someday they probably going to go up. No exit strategy. How do you get your money out? Your money's in tax jail. The only way to get it out is to pay taxes, penalties, all the rest. 401ks are easy targets for estate taxes. They will come back. Oh, look at this one. The government owns your 401k and can change the rules at risk. You don't own it, the government owns it. You may be surprised to learn this, but your 401k does not even technically belong to you. Read the fine print, and you'll find FBO, for benefit of. The tax code makes it technically owned by the government, but provided for your benefit. Certain countries have taken money from these accounts. Argentina, Hungary, Ireland, Poland, France. Could it happen here? I hope not. Won't happen in an IUL, I'll tell you that. Is that enough? Turmoil in retirement. You know, what if you're retired and the market goes down? Loss without a comprehensive plan. Neglect of stewardship and responsibility. So you guys, welcome to our IUL University. I love these things. I want to help you be fundamentally strong so you can build a fundamentally strong team, and so you can eventually become totally financially independent. To me, that's why we're here. We're here to help our clients. We're here to help our agents. But you guys, we got a chance. You have a chance for your family right now to change your future. So, Michael, if you could turn the controls over to Steve. It's my honor to introduce to you Steve Little. Steve and I and Bloom and a couple other guys, we go back probably 30 years. Steve is a leader, came in here with a vengeance, building a strong base shop. You can't succeed until you go build a base shop. I don't care who you are. You need to build a base shop. But I'm so proud of Steve because in his first year full time, Steve made $501.84, $500,001.84. And so, Steve, super, super proud of you. Great job leading the way and showing others how it should be done. And Michael, if you could turn the controls over to Steve. Steve, it's all yours.
Thank you, Petro. Can you hear me clearly?
Hear you great, Steve.
Wonderful, boy. My pleasure to join you today. I want to thank you, everything you did for me along the way as far as coaching and training. The information that we're sharing with you today, Ron Petro shared with me personally back when, and it gave me the guidelines to go forward and build a very, very solid, powerful business. Obviously, you got to recruit. You got to add recruiting and training into that. And guys, I'm going to have those of you that are in our South Lake office, if you could turn the volume down out there. I'm getting an echo, and I don't want that to reverberate through the broadcast here. I would appreciate that very much. We got a training room full of people. I'm in one of the back offices. I can hear it out there. Anyway, you know, like I said, the fundamentals of this business are the key to making money, the key to winning. With that, you've got to recruit, build, train. And I got so excited when I saw the math behind what we're doing, because it's a mathematical equation. And we're going to get into this right here. Let me show you some of the fundamentals. You know, how to win the money game. Warren Buffett has got 2 rules of investing. Rule number 1, don't lose money. Rule number 2, refer to rule number 1. Everybody, I'm sure, would agree with that. But outside of what we do, how do you pull that off? I don't know. And so let's talk about it. The key there is don't lose. You want to avoid market risk. You want to avoid fee risk. And you want to avoid tax rate risk. And, you know, the magic of compound interest is so powerful. Einstein called it the 8th wonder of the world. But the magic of compound interest is negated by the effects of even minor stock market losses. The losses are always more devastating than we allow ourselves to believe. Let's take a look at this for just a moment. We've got Michael here who, with $100,000 and getting a 7.2% return for 30 years fixed, okay? Now, we all know that with the rule of 72, if you're getting 7.2% on your money, we know that money is going to double every 10 years, right? So in 10 years, you'd have 200,000. Another 10, you'd have 400,000. And 10 years later, a total of 30, you would have $800,000. His counterpart here, Bill, is going to start with the same 100,000, but he's getting a 7.2% return for 28 years with a 5% loss in just 2 years. Now, if you look at this in 10 years, he'd have 157, 315, and 632. Here's the amazing thing about that. Bill will always have 21.5% less money than Michael because of a small 5% loss in just 2 years. And something very interesting, it doesn't matter if that's years 2 and 3. It doesn't matter if it's years 12 and 19. It doesn't matter if it's years 28 and 29. 2 5% losses anywhere will wipe that account out to the tune of 21.5%. Powerful, isn't it? Now, let's talk about the power of indexing. We all understand this. This is one of the fundamental tenets of what we do. You know, you've got the red line here. This started January 1, 2000. It ends December 31, 2017. The first few years of this century were very poor in the stock market. Down, 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 down. You start to get your money back. Then boom, 2008 hits. Bam, 39% drop. If you were in the market then and stayed in the market, it took a full 4.5 years to get your money back. And at the end of calendar year 2017, you've got $169,000. Quite a bit of ups and downs there. Now, the rules of this program, you got a 0% floor. You get up to a 12% gain. This is indexing. Now, there's various rules with various companies, but in this example, you got a 0 floor, which means you don't go below 0. And 0 is your hero if everybody else is losing money, right? And so when you look at this, you know, if you were in this blue line, you're feeling pretty smart there while your friends are going down in the red, right? And then you get up to a 12% gain. Every year it goes up. Again, down 39% in 08, you stayed level. Let me tell you another way to think of this. It's kind of like an elevator that only goes up. If the market goes up 7, you get 7. That's your new floor. The market goes down 10, you stay right there because you've got a floor at where you are. The market goes up 12, you get 12. That's your new floor. It's an elevator that only goes up. You can see the difference there. In just an 18-year picture, we've got 84% more growth. If you don't understand the power of that, you just don't get it. And here's the key. You only go up, and we've got that tucked inside of a vehicle, an Index Universal Life product that gives you tax-free retirement income. I'm looking at my cell phone right now. And, you know, I think of the cell phones. My first cell phone ever was hard mounted in my car. Okay. You couldn't move it anywhere. It did one thing and one thing only. It made a phone call, and it didn't always do that real well. Every single one of us now today have smartphones, and those phones will do everything but get on the table and dance, right? And just like that product there has evolved, so has the savings vehicle inside of a properly structured Index Universal Life policy. Those policies didn't even exist 30 years ago, but now it's become something that's absolutely phenomenal. Let's keep going here. The fee risk. You got excessive fees and hidden fees by Wall Street, okay? You know, you pay fees both in up and down markets on the whole account. This occurs in the accumulation and the distribution phases, or the income phase of their products. Now, let me ask you a question on that first bullet point. Do you like the idea of paying fees in a down market? you can almost justify in your mind, if they did your really, really good job, paying a few fees on the upside, but not really, not the fees they charge, and surely not the hidden fees. But in a down market, I mean, Mr. Broker, I lose money and you still make money. You go buy a new Mercedes and I took a 30% hit to my retirement program. That's not right. These fees can be as high as 4.44. The average is 3 to 3.4. Think of this 1 second. A one-time investment of $1,000 that grows at 10% per year with no fees for 30 years will have an account value of $19,000. Take that same exact account, throw a 2% fee in it, you've only got $7,500. Gang, I've been doing this for about 18 months. I haven't seen anything with just a 2% fee. They've all got more than a 2% fee. So what does that do to your values? It destroys them. One of the things I do, I get a compound interest chart. I just made a 5%, 7, 9, and 11% column. I took it down 40 years. I show the client what the difference. When you do that, the difference between a 2% gain over 40 years will double your money. What that also says is a 2% fee over 40 years will cut it in half. If you've got a 4% fee, it cuts it in half again. Excessive hidden fees by Wall Street. The solutions: reduce the fees, long range. Disclose the fees. There is no free lunch. We've got fees, but we disclose them. Reimburse beneficiaries and all the fees on the death benefit. Now I want you to think of this. Let's take a look at this. We've got a book written by an actuary. He said the fees on a good IUL product are about 3/4. It's 3/4 less than what the fees on a brokerage account will be, like a 401k type of account. So you reduce the fees, you disclose the fees, and then think of this. Usually the fees that we charge within our product are all paid back to the client's beneficiaries upon their death. Isn't that a smoking concept? It's unbelievable. IUL is most efficient when you need it to be. And when do you want it to be efficient? Right up front. Excuse me, on the back end. Right up front is when it's least efficient. The only time the IUL product is not the best option is if a person is going to get in and get out in the next 12, 18, 24, maybe 36 months, okay? But if it's a long-term vision, if it's a long-term vehicle, there is no question this smokes everything out there. So the tax risk, the greatest wealth eliminator on the planet, taxes. The current national debt, you go to the national debt clock, the current national debt is 21 trillion. In the last few days, we've passed the $21 trillion mark. The interest on that debt is over $1 billion a day. If you throw in the entitlements, the debt is 76 trillion. Now I want to slow up a second. I want to talk to you about this a second. Steve, where do you get that $76 trillion number? Well, the U.S. government gets away with accounting practices that none of the rest of us could. If, let's just say, hypothetically, we had a car loan and it was $25,000 and we were going to pay it off $5,000 a year. If we did a financial statement, every one of us would show that we've got a $25,000 debt. The U.S. government would look at that and they say, we've got a $5,000 debt this year. When you look at that $21 trillion number up here, that 21 trillion represents what's owed for this year, none of the future entitlements. When you add in all the entitlements, the life expectancy of those that are in retirement mode right now and on those various government programs, the entitlement debt load is $76 trillion. That's $250,000 for every man, woman, and child living in the United States. You have a new baby, that baby comes into this world with a $250,000 debt hanging on their head. Does it make sense with that kind of a liability hanging over the heads? Does it make sense to defer your taxes to a future tax rate? Heck no. I had this guy the other day. He said, but Steve, Trump's taking taxes down. I said, you're how old? 42. You're going to retire in how many years? 28. You think Trump's going to be in office when you're retiring? Who knows what's going to happen in the political environment? Let's get that off of the table. I love our country. Slice my wrist. I bleed red, white, and blue. But I don't trust the government in my retirement. Do you? Let's get the government out of your retirement. Does that make sense? Do you want tax-free or taxable? That's what I thought. Let's go. So the solution is the Index Universal Life. There's a power of zero tax bracket at retirement that's possible. According to Congress, if Social Security, Medicare, and Medicaid go unchanged. Now, let me ask you a question real quick. Is there political pressure to leave those programs unchanged? You bet there is. So if Social Security, Medicare, and Medicaid go unchanged, the rate for the lowest tax bracket would increase from 10 to 25%, the middle bracket from 25 to 63, and the top bracket from 34.9 to 88. Well, David McKnight wrote a book, Power of Zero, and he quotes that in there, and it is a powerful thing. So if the middle bracket has a chance to go from 25 to 63, does it not make sense to have a tax-free income? You bet it does. So let's look at the 4 phases of retirement planning, okay? With an IRA or 401k, one of those that is tax deferred, the contribution is tax deductible. The accumulation phase, you got temporary tax deferral. In withdrawal, it's taxable. Now let me ask you a question. Do you really want to be paying taxes when you're retired and have no income? I mean, does that make sense to set your whole retirement program up where you're paying taxes when you've got no new income? That's not too smart, is it? When you transfer it to your kids later upon death, it's taxable. Let's look at a tax-free alternative. On the front end, the contributions, they're not taxable. It's tax deferred forever. There's a tax-free benefit as it relates to living on that money. And when you transfer that to your family, it's tax-free. Doesn't that just make sense to do the second one? It's incredible. Eliminate tax on distribution, right? Let me say it another way. An example I like to use, if you had an apple seed and you could pay tax on that seed one time and then plant it, and you got tax-free apples forever, does that make more sense? Or does it make sense to write the taxes off on that one seed, defer all the taxes, and then every time you take an apple off that tree later, the government's sitting there with a pocket knife taking a slice off every apple? People always want tax-free. Let's take a look. Let's roll all this together. We got a person here going from 35 to 65. They're putting in $1,000 per month. They're getting 10% a year for 30 years. At age 60, with no market risk, no fee risk or tax risk, okay? At age 65, they'd have $2.4 million. Pretty sweet, right? $2.4 million. However, let's allow for some market risk here. We're going to get 10% for 27 of those years. We're going to take 5% off once. We're going to take 0 1 year, and we're going to get a 5% return 1 year, okay? You just lost $500,000. Let's put a fee of 1.5%. And once again, it's almost always double that. You just lost another $500,000. Let's throw some taxes in there for good measure. 25%. You just lost $400,000. Your $2.4 million went down to $957,000. There is tremendous, tremendous risk when you got market risk, fee risk, especially when they're unknown and hidden, and tax risk. Let's take those off the table. They can take 60% of your funds. The solution is the IUL. Your principal is protected, no market risk. The elevator only goes up, not down. Your index growth is linked to the S&P. You believe in the stock market? I do. You believe in the market? Tie yourself to that. Are there going to be ups and downs? You bet there are. There's going to be a lot of them. The income is efficient at retirement. What does that mean? Very low fees at retirement time. Liquidity, absolutely, and without taxation. It's IRS penalty free, tax-free distributions. What do I mean by that? Well, let's just pretend, see, retirement is a financial condition, not an age. Would you agree with that? So let's say you've got enough money put together by age 50. Does it make sense you should have to pay a 10% penalty to access your money? I don't think so. With an IUL, there is no penalty. It's not tied to the IRS. It's not qualified, meaning you got to qualify to get it back. Lower your fees long range with the IUL. Eliminate the taxes on distribution. Avoid market risk. Protect your principal. Boom. We got the ultimate product to take to the marketplace. There's 150 million people that don't have living benefits on their program, and there's 100+ million people that have a retirement program that is loaded up with taxes coming, and they don't even know what the tax rate will be. There's tons of people that need our help. Ron Blumenkemper, when he told me this story, said, Steve, we've got the biggest opportunity that's ever been in this industry. I looked at it closely. I saw it. It was absolutely real. I went out, charged hard. We started with a bunch of greenies, no insurance guys. First full year, we made $500,000. Appreciate it, Ron. Appreciate it, Petro. Back to you, Ron Petrinovich.
Steve, great job. Thank you. Hey, everybody. This presentation that Steve just shared with you kind of lays the foundation for the university. In other words, you know, we talk about a crusade. I am totally into the tax-free crusade. 21 trillion in debt, $1 billion a day of interest. I mean, honestly, if your neighbor's house was on fire, would you go over there and tell them? Because I'm going to tell you this, your neighbor's retirement is on fire and they need your help and they don't even know it. Even all these smart engineers in Silicon Valley, I mean, just those 13 things we listed in the beginning. Did you know you don't even own your own 401k? It's for the benefit of you. It's the government's money. So I get passionate about this stuff. So thank you, Steve. Great job. And by the way, everybody, I want to point this out. Steve has an office full of people attending this IUL University. I recommend you do the same thing if you want a $500,000 income in your first year full time. Okay, next speaker, Michael St. Clair. You guys, I want Michael, and this is really important in your strategy. You know, some people have money, some people don't have any money. If you come across people that don't have any money at all today to put away for retirement, do not walk away, sell them a term policy. And you guys, when you sell an IUL, super important, we're going to put the minimum amount of life insurance so that policy is efficient. Most of the time when you sell an IUL, when you do this job the right way, you're going to want to add term life insurance to it. The term life insurance with American National has 14 triggers for living benefits. You guys, term in America is pretty much a commodity. Living benefits takes that all away. If you own term life insurance and you bought it off a website and it's only a death benefit, get rid of it. You got the old stuff. Well, don't get rid of it till you got your new policy. So you guys, I want to say this. If all we did was sell term insurance with living benefits, if we didn't have anything else, we would have a huge opportunity. So I just wanted you to see how simple it is to get term quotes. And I urge you, when you sell the IUL, add a term policy, 25, 35, 50 bucks a month. Michael, it's all yours.
Hey, thanks, Petro. Hey, and great job, Steve. Steve's always an energizer bunny in the morning. So if he doesn't get you going, I don't know what will. But like Petro was saying, you know, I firmly believe the same thing. Utilizing the term behind the IUL is very important. It's income protection for us as well. So how easy is it to get a simple term quote? Go out to IMG, stands for Independent Marketing Group, .anacoweb.com. That's all you have to do. This will take you to the landing page that we're looking at right here. Best part about it, you don't have to be able to log in. You can do a term and a simple GUL quote if you wanted to from the front side of the website. So we're not logged in here at all. So we're going to come up here. We're going to hover over the expert office, go all the way here to the left-hand side, term and GUL quote. Click on that little link right there, and it's going to take you into a simplified term quote engine. Very easy to utilize, and usually pretty quick. So today it looks like it's running a little bit slower. All right, but with all that being said, give me a second here while it loads up. All right. Try this again. Sorry about that. Well, Petro, I'm not sure that. Are you able to get it loaded up on your side? For whatever reason or another, on mine, I'm not getting the. This is cut all way back. Just this way. All right, try it all
Michael,
over
give
again.
it another minute. We'll try it. If not, I'll start and we'll come back to it.
All right.
There we go. Okay.
Wow. It was working before the call a little bit, but not this slow at all. I've never seen Anacode this slow at all. All right.
Michael?
Yeah.
Oh, there we go. Is that it?
I'm not getting any response from it.
So let's do this. I'll do the sales presentation and then we'll try.
Okay. Sounds
Try
like a plan.
again.
Let me turn it over to you.
Turn it over to me. Okay, get rid of that one. Show my screen. Okay, everybody. We'll take a little detour. Okay. It's important for me to tell you this before we get started. All of the presentations you're going to see today, including the one that Steve just did, those 13 things about the 401k, these are all in our back office, in your back office. So log into FEG back office, put your number in and all that, hit back office, go to tools, and look for it. It's there. Okay? And if you can't find it, call the FEG home office on Monday. Okay. Now, you guys, we sit down with a client and we walk in, and mentally now, this client, do not rule them out as a potential recruit. If you walk in and all you're doing is selling insurance, then you're an insurance agent. You're not a builder. You're never going to duplicate yourself, and you're stealing an opportunity from yourself. I want to share something with you from a couple perspectives. One, for your own family and your own retirement, your own protection. Two, I've got an incredible business opportunity. I understand it's not for everybody. It might not even be for you. But man, if you did like it, there's a ton of money to be made. So we go on this appointment with two things in mind. Don't go there just selling insurance. And the next thing I want to mention to you is this. I see a lot of agents that don't have very good persistency. And if you don't have good persistency, you're not going to last very long in the business. And I believe they have poor persistency. That means the clients don't keep the product and they get chargebacks. If you don't have good persistency, you're just taking shortcuts. Because when you educate the client on what we've got, they're going to keep it because there's nothing better for their family. So you need to have good persistency and follow the system. So we're going to sit down. We'll just call our clients Bob and Sue. So Bob and Sue, I want to talk to you about the new world of money. I want to talk to you about learning how to upgrade your money, your protection, and your insurance technology. I want to talk to you about a smarter way to go. So let's just say this is right here, Bob and Sue. And Bob and Sue, here's the $1 million question. Will you live a long, healthy life? Certainly, we all hope so. Or will you become one of the 6 million people a year that get sick along the way of life, bad stuff like heart attack, stroke, or cancer, and most of those people go bankrupt? Will that happen? We don't know. We certainly want to live a long time. Or will you unfortunately die too soon in some sort of an accident or illness? See, the bottom line is, everybody, we don't know what our future is going to be. And it makes sense. Doesn't it make sense to protect this family in case of all three of them? That's the beauty of the IUL. The life insurance death benefit, the living benefits, get a check for $500,000 in case you get cancer, but also the tax-free life supplemental savings, the retirement aspect. So let's talk about the saddest one. You die too soon. If you're gone and your paycheck is gone, how's your family going to survive? Would you want your mortgage or other debts paid off? If you're a renter, would you want the rent paid for the next 10 years while the kids are growing up? Would your family still need a reliable monthly income? Or could you make it on your wife's income? Or does she even have an income? And if you need that additional income, how long are you going to need it for? You need to know that benefits from life insurance policies are income tax-free. And life insurance comes three ways, depending on your budget. You can rent your life insurance for 20, 30 years, called term. Term life insurance terminates at some point in the future. The good part is in the short run, it's low cost, short run. The bad part that almost nobody knows, super expensive in the long run, the most expensive policy there is, and only 1% to 2% of these policies will ever pay a claim. It's designed not to be enforced when you die. It is what it is, but if you got no money, it's a great plan to have. And if you need additional protection while your kids are young, it's a great plan to have. I've got 3 or 4 of them. Next, there's a policy out there called a GUL, Guaranteed Universal Life, and this is permanent. It doesn't terminate. Designed to last throughout your life. If you don't need it in later ages, you get all your money back. But it's designed to be enforced when you die, as opposed to the term. You guys, the ultimate plan is the IUL because it's got the death protection, it's got the living benefits, it's designed to be enforced when you die, and super important, it's going to give you a tax-free retirement income. So if you die too soon, you need life insurance. And by the way, less families own life insurance today than at any point in our lifetimes. That's one of the reasons this opportunity is so big. Okay, moving on. Let's say you suffer a critical illness. Every year, over 6 million people will have a heart attack, stroke, or cancer. The average age of a critical illness claim is 43. Very odd to know that the average claim of bankruptcy, by the way, is 44. People get sick, can't go to work, no income, go bankrupt. Now, of the 6 million people that have these illnesses, 70% of them survive. But 52% of them go bankrupt. So there's a trend, and you need to answer this question. If you get real sick and you can't go to work, and maybe your wife can't go to work or husband because they're home taking care of you, who's going to pay your bills? Bad enough to get sick, even worse to get kicked out of your house when you're down. You guys, we solved this problem with 3 living benefit riders, not 1, not 2, 3. Critical, chronic, and terminal illness riders are available with this new modern kind of life insurance at no additional cost. Critical illness covers heart attack, stroke, cancer. With Anico, it covers 17 different things. Chronic illness rider, I look at it as a long-term care alternative. 90% of Americans don't own long-term care. Message, if you don't own long-term care, get a life policy with a chronic illness rider. And terminal illness, some companies up to $2 million and up to 24 months. If your doctor says you're going to die in the next 24 months, this life insurance policy is going to pay off big right now. And with these benefits, you can do a full or a partial acceleration. So in case you get sick, we send money. Here's a client of ours, Dave Tringali is client. I saw you on the webinar, David. Good to see you here. Dr. John became a friend of mine, buys a policy in the first month, gets throat cancer. Living benefits paid him $735,000. He was able to pay the copay, which was well over $100,000. Doctors have good health insurance. His copay for good treatment was over $100,000. See, so many people get cancer and they got no money and they got to go on the cheapy treatment and they die. I think living benefits had something to do with Dr. John living and enjoying the rest of his life. Here's a video that I'm not going to play right now, but go to your replicated website. It's important that you watch these videos. Here's a guy named Chris. He gets cancer. With his benefit, he's able to pay off his house, buy a house for his kid, throw a wedding for his daughter. He didn't lose everything. He survived the cancer. You guys, we're saving lives, and that's a crusade. These riders can be used, as you saw, pay off your home, the best medical, bucket list, college funding. So many people, they get sick and their kids are in college and it ends their college career. And the good news is no matter what budget you have, we can get you living benefits. Term, GUL, IUL. And I'm proud of that, you guys. So if you get sick and can't go to work, I'm going to say this. Every family in America needs living benefits. I want to say this to you personally on this phone. If you don't have living benefits, get them. We've had some of our CEOs of our company, field CEOs, didn't have a policy on their wives and their wives got cancer. Cover your family. If you don't have money, do term. It's cheap. Okay, now. Now, Bob and Sue, we're going to get to what I think is probably the most important part. Because more than likely, you're not going to die too soon or get sick. More than likely, you're going to live a long, healthy life. Now, most of our country's savings for retirement are locked up in stock market risk-based products. And I think it's a dumb thing to do. A large percentage of this retirement money could be lost to market risk, will someday it'll crash, fully taxable, lost to taxes, and fees are going to take over half that money. That's a disaster. You know that a market downturn can delay or destroy your income plan? What happens if you run out of money in retirement? Doesn't it make sense to fully eliminate the risk? Doesn't it make sense to have a tax-free versus a fully taxable supplemental income? What do you want when you retire? Tax-free check, taxable check? Kind of a dumb question, right? I want to show you a way to eliminate market risk, eliminate taxes, and reduce your fees. And by the way, get something for your fees instead of nothing. And when you die, you're going to get all those fees back to your beneficiaries. That's what we do for people. So I want you to think about this. The day you are done working, are you going to be dependent on the government or independent? The day you retire, if you have no money, you are 100% dependent on others. And my job is to help you become independent. Isn't that a good job? I'm here to show you how to become independent someday. So who's going to pay your bills? The government? Look at it, it's outdated already. 21 trillion in debt? Is Social Security going to be enough? Are you going to be eating cat food at retirement because you can't afford real food? Do you have a pension? Most don't. Your IRA, 401k, what's your future tax rate going to be? You got to think about this. Or will you be reliant on the government and your children? So your children could be struggling too, right? Now, so let's talk about Index Universal Life and annuities. There's a place for both here. I want to talk to you about the greatest wealth accumulation plans of our time. You know, Tony Robbins in his book says, invest like the wealthy, not like the broke, where you participate in the gains but are guaranteed to never lose. So you guys, this is exactly what we do. You know, not knowing a lot between the red and the blue, which one would you rather be on with your retirement dollars? That's kind of a no-brainer. Not only 40% more money, but 40% more money without having to take a risk. You know, Steve told you earlier about Warren Buffett. Don't lose money. That's what we do. We don't lose money. We get all the gains with a cap. In fact, you're going to find out later today, some of our indexes have no caps. One of my favorite books, The New Rules of Retirement Savings. In this book, Martin Ruby says, today's most popular ways of saving for the future, IRA, 401k, dumb plans, are creating some of the biggest risks in modern financial history. And people don't get it. Most people are trying to solve a modern day problem with a 30-year-old solution that flat does not work. Read the book. This is my favorite book right here. As Steve showed you earlier in The Power of Zero, I've never been on an appointment in my life without these two books. Power of Zero. What if taxes go to 63? They go from 25 to 63. You're going to call your 401k the dumb plan also. I didn't write the book. I'm not in Congress. That's what Congress said. You know, when it comes to retirement, we have a choice. U.S. Tax Code, Title 26. You can hit Section 401k, taxable income at retirement. You can go to U.S. Tax Code, Title 26. Go to Section 7702, tax-free income. Taxable, tax-free, it's your choice. You know, isn't that a big deal? You know, our indexes keep getting better and better. You know, the S&P index, you're going to see a product today with a cap of 15.5, a gold index, a real estate index, new indexes with no caps. Some of them, no fees. Now, so if you live a long time, I'm here to tell you this. The IUL is the most efficient retirement income machine on the planet. Nothing is going to beat it. Nothing is going to beat it. And by the way, everybody, I wish for you this kind of confidence. And I'm confident because I've taken the time to read these books, study my stuff. That's why I'm so passionate about it. And I'm going to tell you what we're doing here right now. This changed my life. I mean, I truly have a free life. And I want the same for you. It's worth any price you'll pay. So, getting back to this family. Indexed Universal Life solves all this thing. You live a long time, get sick along the way, or die too soon. See, we just don't know what's going to happen. But now we need to be thinking about how much can you put away? With your brand newest recruits, don't just sell them a policy. Change their retirement future. Don't just sell policies. Change people's retirement future. Care. So what's the next step, Bob and Sue? The next step is we're going to sit down and we're going to prepare a personalized needs analysis. I'm going to go a step beyond the dodo brain agents that don't do this. We're going to help you figure out how much you need. We're going to create an affordable strategy. And I'm going to help you find money to fund your retirement. We're going to help you find the money. So you guys, that's the presentation. And you guys, if you learn how to do this with passion, every time you don't take shortcuts, you're going to close almost everybody, and they're going to keep the policy when you do this the right way, and I guarantee it. Pretty strong, huh? I guarantee it. Okay, now, step 2. So we're sitting down with Bob and Sue. Step 1 is to do a presentation. I know some agents are too lazy. They just talk briefly about it, sell them a policy, they get the policy, they cancel a couple months later, you get a chargeback, you fail. Teaching you how to do this the right way. Okay, now, go to step 2. Step 2 is a proper needs analysis. By the way, where do you find this thing? It's on our website. Okay, now, so we got Bob here and Sue over here. So what if Bob dies? In case Bob dies, I ask Sue all the questions. Sue, over here, Sue, if Bobby dies, do you have any debts such as car loans, credit card loans, student loans, any debts you'd like to have paid off? She goes, yeah, Ron, we got about $35,000 of that stuff. Okay, mark it down. Sue, if something happens to Bobby, you're probably going to have a funeral, and those aren't cheap. I threw one for my mother. It was considerably more than $25,000. In some cultures, these things are $50,000+. So you put in whatever number. So if something happens to Bobby, his income's gone. Would you want the mortgage paid off? What do you think that wife's going to say? Or would you, if you don't have a mortgage, would you want the rent paid for the next X amount of years till your youngest kid reaches age 18? Of course you would. Put the number in. I'm being very conservative on these numbers. If something happened, Bobby and Susie, would you want your kids at least to have a chance to go to college? Would you like to leave something for them? I highly recommend $100,000 per kid. I sent my kids to good schools. It was $50,000 a year. And they go, yeah, $200,000 there. And then last question, but most important one, Susie. If Bobby's gone and his income's gone, can you make it on your income? You got a couple kids. Would you need income? She goes, Ron, I need probably an extra $15,000 a month. I go, no, Susie. You know, it's not party time. What's the minimum you'd need to get by? She says, well, I'd need a minimum of $3,000 a month. $3,000 a month for 10 years. This, you know, it might be longer, but in my example, that's $360,000. So you guys, this client needs $870,000 of insurance. And by the way, that's low. The average family is going to need closer to like $1 million plus. Okay. So that's the what if you die. We're not going to get into it now, but I go over on the other side. Now, if wife dies, hubby, what do you need? And if that's if she's a homemaker with kids at home, minimum 250. Minimum is 250,000. Okay, next. From what if you die to what if you live? And this is now it's getting real important. Now we're talking about your future. You guys, if you get good at this part right now, your average premium will double, triple. Okay, now, first question, Bobby. This one's going to be now for Bobby. Bobby, how much can you afford every month to put away in case you live? You know that if it's $25, you ain't going to have any kind of a good retirement, right? We need to find real money to fund these things. He says, Ron, things are tight. I only got $100. Okay, Bobby. $100. Let's see if we can add to it. Bobby, do you have any current life insurance? Yeah, I got State Farm. I got a old-fashioned blah, blah, blah policy. I'm paying $100 a month. Okay, Bobby, we're going to throw that into the loop here. And we'll get to Susie here in a second. We're going to throw that. It's probably got no living benefits. We're going to throw that into the pile. Just in case you die, but in case you live or get sick. Bobby, you put any money in your IRA 401k? Yeah. Stop. Don't do it. If they're matching you, okay, I can understand that, but I know too much, and that's even dumb. But sometimes it's going to take a few hours to prove that to somebody. So if you got a match, I understand. But anything about over the match goes into here. But warning here, warning. Once you're dealing with their IRA or 401 contributions, you become a fiduciary. There's some new Department of Labor laws. So just make sure you fill out the proper forms. Be aware of it. Talk to your field trainer about it. It's no big deal, but you need to CYA cover your rear. Next. So now I got $300 a month. Okay, next, tax refund. The average American gets about $2,000 to $3,000 a year of tax refund. I know it's convenient, but that money's not making you any money. It's a tax-free loan to the government. Why don't you use that to become financially independent? So let's take 150 of it, and that builds me a budget of $450. So I got a guy said I only got $100 a month, but because I'm a stud, and because I care, and because I work a system, I took $100 a month sale to $450. Isn't it kind of cool to make 4.5 times more income? You get it, right? By doing the right job. I see, you guys, I don't just sell IUL. I believe in it. I own it. I've been putting $7,000 a month in for 10 years. When I say it's the best retirement plan in the world, I mean it. I do it. When the market crashes, I don't lose any money. Are you able to talk about your IUL? Do you believe in it enough to do it yourself? And I'm not talking about a mini $50. What are you doing for your retirement as an agent? The second you put real money in, you're going to be 10 times better in the field. Now, Bob, before we move on, do you have any money in the bank, under the mattress, any blah, blah, wherever, mutual funds? You got any non-qualified money that you'd like to jumpstart your retirement with? 10, 20, 50, 100,000 sitting around somewhere? Do you have any old qualified funds, any old 401k sitting around? If you do, we'll need to analyze, would it be better to take it out, pay the taxes now, and put it into an IUL? By the way, Department of Labor laws apply here. Is your 401k movable? Or does it have to sit where it is right now, fully at risk? ask these questions. There's more money on the table here. Don't, you know, and a lot of it's what's the client's age, all that kind of stuff, health. This is where you become a pro. Now, Michael, I'm going to bring it back to Michael for a second. Were you able to get that term thing to work?
Oh, absolutely.
Okay, so why don't you switch it over to you? You guys, we're going to have Michael just go through and show you how easy it is to sell term and how to get a quote. And if they don't have money for IUL, don't walk out without a term application. Michael, it's all yours.
Awesome. Hey, thank you, Petro. So hopefully this works for everybody now. Like Petro was saying, the term is super simple, especially with Anaco. After we log in, you're going to click on the expert office and then go over here to term and GUL quote. It'll pull you up into a client information page. Simply select the Anaco signature term up here at the top. And we're going to be in the state of California today. And the client's going to be 35. So let's say he's a New Year's baby. So January 1st of 1983, 35 years young. Male, go ahead and click continue. Tobacco, pretty simple and basic. Nicotine user, non-nicotine user, one of the two. Coverage amount, anything under 250,000 is going to be automatically expressly underwritten non-med. So, but in this case, we're going to look for 500,000. Underwriting class, Anaco is considerably liberal on their underwriting when you compare it to other companies such as AIG, where it's a little bit more conservative. So in this case, we're gonna stick with preferred, and we're gonna use a special monthly or PAC or automatic bank draft. All you gotta do after that is click calculate, and automatically you're gonna get all of the term durations calculated for you in one place. So your ARTs, your annual renewable term, we don't sell a whole lot of that, but you really want to focus on anything from the 10-year to the 30-year. And in this case, utilizing the 30-year, his guaranteed premium for 500,000, and he can convert that 500,000 to a permanent policy, whether it's a GUL or a IUL down the road if he chooses to. It's only $46.22 a month. So utilizing that $450 that Ron found on the IUL sheet and the needs analysis sheet, more relatively, we still have about $400 left now that we could start funding his tax-free retirement vehicle with. So it's that easy. And if you guys need help on getting it done, please don't hesitate to give me a call. I talk to, I deal with a lot of agents and a lot of illustrations throughout the day. And on a side note, because this is going to lead into doing the IUL now for everybody. On a side note, for the longest time, there's been a couple of companies out there that had the number 1, 2 IULs in the industry, and I'm happy to announce today to everybody, I've gotten some real life case examples, sent to my direction with a couple of those carriers, and Fidelity and Guarantee's newest product, the Freedom product, beat out the competition in excess of $10,000 a year of income on a basic run. So what's that mean for you? There is no competition when it comes to either our term, to our GUL, to our IUL at the end of the day. So you should be confident knowing whether it's a term to term convert, you're just replacing, or you're just outperforming the competition, it's going to be done. And so today leads us up into
Michael,
Fidelity and Guarantee. Yes, sir. Yes, sir.
Let me go back to those term quotes real quick. I just want to say one thing. Okay.
Yeah.
So you're sitting with your client, you guys, and you show them this. And I want you to think about a couple things. Obviously 10-year term's cheaper than 30-year term. And you got to take into account what's the age of your kids, all that kind of stuff. But it's not that much more to get a 30 or a 20-year term versus, the others. And these policies, like Michael said, are convertible. And if someday you were to convert to a GUL, understand that GUL comes with a complete return of premium. You get all your money back. Or at an older age, sometimes people sell policies. Some people own life insurance policies into retirement, and they go sell them on the open market and cash in for hundreds of thousands of dollars. So anyway, you guys, be familiar with the term. And I'm going to say this, I said it earlier, I think every American family needs to own some sort of a term policy with living benefits. Okay, Michael, now, so what we're going to do now is we're going to take give the controls over to Michael. We're going to take this 35-year-old, we spent about $50 on the term, and we're going to put $400 a month into the IUL. So we're just going to go real quick through an illustration, and then I'm going to show you how to close the sale.
Awesome. All right. So with the illustration, I've already kind of went through the beginning part. You fill out the basic information, what state they're in, find available products, select the Index Universal Life. The Synergy Global Advantage Freedom is the new product. So there is the Gold and there's the Freedom. So we're using the Freedom today, and that is the newest product available. And with this, keep in mind, they have a unique underwriting process with this now as well. Not every case will require a paramed. It's up to underwriting discretion. So keep that in mind. This product, though, is specifically designed for 18 and up. It is not a juvenile-based product. Just so you know, we're not doing $1 million baby on these types of policies here with the Freedom, but you can still use it on the Gold. Underwriting class, we're going to use preferred. And one huge thing, so everybody understands, if you're new in the business, Fidelity and Guarantee issued about 93-94% of all of our policies last year that we submitted. That is a huge number to be able to do that. So do we have confidence in their underwriting and get policies issued and out the door? Absolutely. So we're going to come down here under the solves for, and we're going to select max accumulation, then withdrawal. But first, I want to show you one simple trick that will save you some time. Don't go here first. Actually, come down here under the premium and simply select monthly automated draft. If you don't, it's automatically going to default at annual. And what will happen is you'll go through this whole process here. Then you'll come down here and you'll switch it to monthly, and it'll take whatever number you just put in and divide it by 12. So then you have to go back and do it again. So to save yourself about 2 or 3 minutes, start right here, switch it to automated bank draft if they're going to use monthly. Then come back up to your max accum, then WD. We're going to click on details. And on an IUL, we're solving for face 99.9% of the time. And the reason being is this. We don't care necessarily about the death benefit too much in the aspect. We want to shrink that death benefit down to maximize the amount of money we're putting in and to maximize their tax-free retirement. So once we hit solve for face, this box will automatically pop up. And I've already went through and pre-done this for us. So we're going to type in $400 a month starting in year 1. Now we're going to scroll all the way down here. And at age 68, you'll notice that'll show technically that'll be our last premium. However, it will pay through 69. So we'll pay all the way up through 69. So we're going to zero 69 out, click OK. And the same year that you stopped, the same year you stopped paying your premiums, you're going to start as the income. Now, when you do that, it's actually going to start it at age 70. So it's always a year off on the illustration. And loan type, I get a lot of questions about loan type, and I want everybody to understand with this specific product, and there's not a lot of products out there that can say this. The maximum variable loan rate is 5%. So can you be aggressive on the variable loan rate and make it 5%? Yeah, absolutely. Right now it's about 3.8, but it's not ever going to go higher than 5% once you have a IUL policy in force with Fidelity and Guarantee. And you could also use fixed, but here's the thing. We want a variable interest rate, and we also want to participate in the market gains. And that's what we're going to do here. That's the magic on top of compound interest and being able to use the positive arbitrage for your advantage. So after you do that, you don't really have to worry about face amount. It's automatically going to be an automated solve for you. Now your death benefit options. You have 2 choices, option A or option B. Option A stands for level. Option B is going to be increasing. In this case, we're going to use option A. We just want to keep a level death benefit from the time he's 35 on. So we're not going to change anything there. Premium mode, this would normally be set at target, but we're going to select specified, and it's going to essentially take you to the same box we were just looking at on the specified premium. So you can just double check your work, make sure everything looks the same way it did before. and then simply click OK. And on that point, the page will reload for you. Now, don't worry about pay premiums to or forced minimum premiums to year. You're only going to utilize this if you're not using any solves or up here. So you don't have to worry about this at all right here, unless you're going to use a lump sum. Now, interest crediting options. Now, there's a few features in this product that I love personally. One being is, let's start with the top. You get your regular S&P annual point to point, and like Ron said, high cap 15.5%. And so everybody understands, where do they get these, these illustration rates and the caps? Every company has the same guidelines, 65-year look back. They have to go based on the same guidelines that were put in force a couple years ago, a few years back. So now it's up to them to set their caps. But the second option is 140% participation rate S&P. Now, it's going to have a lower cap. Now, one of my favorite indexing strategies is the monthly point to point. Now, with this, you're going to have a 4% cap per month, which could give you, in essence, up to 48% a year of growth. And it's on a monthly point to point. Right now, it's illustrating only at 6.87. But if you go back and look at, month to month, you could see you could see decently sized gains throughout years. So, and the good thing with F&G, it's simple to figure out because their sweep dates and allocation date is on the 15th of every month, as long as it falls within the working days. But the newest indexing option on the IUL and in the market today, and if you look at its past performance, is outstanding, is the Barclays annual point to point 190% participation rate, uncapped, no spread fee for the client. Now, I'm going to reiterate that 190% participation for your clients with an uncapped strategy, and it doesn't cost them a dime to utilize that index. That is huge for your client. So that's going to illustrate at 8.26%, and we're going to put 100% in that. We still have the real estate option if we wanted to right here, and we also have a fixed option that's at 4.5%. The variable loan interest rate today, 3.88. So we're going to keep it at 3.88, and we're not going to use any withdrawals or loans because we've already used the solve for that. And additional benefits, I'll cover this here really quick. Waiver of monthly deduction. That's pretty much, you see that on a lot of policies and IULs. Children's term rider, accidental death benefit rider. Now, one unique thing about F&G, they do not sell term. However, they sell A-level term rider that you can utilize only on an IUL that actually allow you to lower your face of your IUL and use the term rider to increase the face so you can put more money into it. Very unique. I love that rider. It's really there to overfund your policy. And living benefits and monthly charges and expense report is automatically selected. You need to get good at talking about this page because clients will ask eventually, especially clients that are spending a decent amount of money. Once you have all of that done, you're going to come up here. You're going to click View and Print Illustration. Now, anything under $250,000 has to be done on e-app. So anything over that, it can be done on paper, but anything under is required on e-app. And I recommend e-app for everything personally. So after you click View and Print Illustration, it's going to pop up to a nice looking illustration by Fidelity and Guarantee. And we're going to simply scroll down here. You're going to notice we got a $404,000 death benefit day one for $400 a month. And monthly no lapse premium. I want to kind of let everybody understand what this means. This means if the client just pays $175, nothing else, and 4 cents, for the next 15 years, their policy is guaranteed to never lapse. So for the people that might come in, when they say, well, what happens if I can't make my premium? Can you at least make the minimum? Because the last thing you want to have happen is a lapse. So with the Fidelity and Guarantee product, they have a fantastic 15-year no lapse guarantee clause in there as long as you make the minimum premiums. Guideline single premiums, $54,000, and we'll keep scrolling all the way down till we get to the important part, and that's the numbers, what every client wants to see, factual numbers. Now, Petro's been doing this a whole lot longer than I have. Pedro and I have been working together for about 15 years. I've known Pedro since I was about 10, but I can't tell you the last time I seen an option A soft, Pedro, that gives me this much cash, cash surrender value that early on. When I look at other companies and I do a bunch of illustrations every week and every day for our agents, this is outperforming everybody early. And I think that's a strong feather to F&G's cap and what they're doing for their products. Now, scrolling all the way down here, you're going to notice putting our $4,800 a year through 69, it's a total of about 163,000. Now, after that, we start withdrawing on a $57,411 a year tax-free income based off of the numbers here. So, and we're going to take this all the way out through age 99. So all the way up to 100, we took it out. Now, I want everybody to take this into consideration with Fidelity and Guarantee, unlike other companies that we work with. If you do change the duration of your income, it will change your income. Because a lot of clients, I hear them say this to their agent is, well, I see that I have 610,000. Can I get more than 57,000 if I go shorter? Well, in retrospect, yes, you could, but with Fidelity and Guarantee, you actually are able to show that in a lot easier way. And we'll keep on scrolling down here, and we're going to look at our indexing options. I'll scroll in a little bit here, and this is just going to show you the interest crediting that right now that we're using 100% of the Trailblazer, Barclays Trailblazer Sector 5 point-to-point with the spread, and there's no spread on it right now, 190% par. And the best part about this, everybody, as an agent, you can call them. As a client, you can go to their website too. There's a special phone number and website specifically for these people that have designed this index. And I do believe Ryan Parker is going to talk about that, so I'm not going to steal any of that from him. But coming on down, I want to cover one thing, and that's costs. We all have costs, like Steve Little said a little bit earlier, there is cost to everything we do. There's no free lunch. I like that, Steve. That's a good one. Target. We all remember the gold product. If you were with this, last year and so forth, we have low target. Target on this case, $4,100 for an hour, maybe 2 hours of your time. You're making, decent money. You're making more than CEOs make per hour. This is going to give you your 7-pay, your monthly minimum no lapse, and your guideline annual and single as well. Keep scrolling down. This is going to give you your actual historical 20-year backdated looking performance of what everything would look like. And based on all of this, on the 10-year average, you're looking at about 12.83 in the Barclays. So are we illustrating well under 4? Yeah, if you look at the 10-year average, by all means we are, by 4%. So is there room for growth? Absolutely. So this gives you a snapshot of the 20-year, most recent 20-year or 10-year in some cases, what is done. And cost, policy charges and expenses. And like I always said, you gotta have to get good at this page. This is going to be one of the pages that can make or break you in some cases, because a lot of times everybody hears, well, IULs cost a lot of money. Up front, they do, yes, at times. But over time, look what happens. We start with about $800 of premium expense and cost of insurance, plus the $966 for for the expense charge. But after the 10th year, you notice $900 of that goes away, and your cost of insurance isn't that much. At 65 years old, for $500,000, it's $533. But you have benefits in the excess in cash for $427,000. So would you trade all that for roughly about $800 of cost for about $500,000 for your beneficiaries or $427,000 for yourself? Absolutely. Why not? So based on all of this, I'm going to turn it back over to Pedro, and he's going to show you how to take everything that you see on the illustration, especially on the premium, the income, and how to make it digestible for a client in a one-page IUL close sheet that everybody should use, because I promise you it makes it simple, because they don't understand IULs like yourself or me or Pedro or anybody else on this call. You have to think of them as, they are brand new to everything that you're talking about. So you have to make them understand in the most simplistic way possible. And the easiest way to do it is on the IUL close sheet. And
all right, Michael. Great job.
Thank you, sir.
So you guys, kind of summarize what's happened, and then we're going to move forward. So we sat down with the client. We did the presentation, step one. We separated ourselves from what I call the dodo bird agents. We did a needs analysis. We found the funding. We looked for additional lump sum funding, whether it's a non-qualified or a qualified asset. And now we're really prepared to do a great job. We do the illustration. And now it's time to close the sale and keep it as simple as we can. So, and by the way, I got a text from Chuck Small. Chuck's got an office full of people. Great job, Chuck. We're here doing our best. You guys, in the early days of FEG, we did a ton of these because I just felt, man, I got to get people selling this stuff to generate income now. So we focused on this nonstop. What you're learning today, we just focused on it and got a whole bunch of people good at it, and they stuck with us. Now, so this is kind of like Michael said, the summary sheet to really simplify everything we just talked about. So Mr. and Mrs. Client, you're 35 years old. You got a budget of $450 a month for Bob. We took 50 of it, 47 or whatever that number was, and we put it into a 30-year ANICO term. Got all 3 living benefits on that policy. Now we're going to do your IUL / tax-free plan. So I've got a budget of $400 a month. That's $4,800 a year. Pretty simple layout here. We're talking about 35 to 70, so 34 years of contribution. Bob, you're going to put a total in here of $163,000. So the question is, what do you get for $163,000? What's in it for you? And this is where we shine. Okay? Number one, should you die, there's a $404,000 death benefit starting day one. Remember, we have a $500,000 term in addition. And if you have a living benefit incident, I suggest you turn in that term policy first. Absolutely. So should you die, starting day one with that first payment of $400 a month, you got $404,000 in coverage. Now, this policy comes with living benefits. At age 70, you've got critical illness in the neighborhood of $700,000. F&G does not have chronic yet, but you have it on your term, so don't worry about it. Plus, by the time you're older, you just take the income out for your chronic illness benefit, by the way. So temporarily, you got the term for that. And then you got a terminal illness rider up to, these are both up to $700,000, depending on how severe your sickness is. But you really don't buy these things for just dying or just getting sick. You can buy them for the tax-free income. And in this policy, the tax-free income is $57,411. So, Bob, I want you to think about this. In your working years, you're putting in $4,800. In your retirement years, you're taking out $57,000. Did this retirement plan deliver? Absolutely. And if you're in a combined tax bracket of 33%, like many are, state and federal, depending on what state you're in, 57 tax-free is like making $76,000. So it's more like this than like this because we're used to paying taxes. Now, we don't know how long you're going to live, but 1 in 4 live past the age of 90. And if you do live that long, by the time you're 90, You pulled out 1.2 million. So think about that. How much did you put in? 163. In between, you're covered if you die or get sick. But then you start taking this income out. You live long enough, you've taken out 1.2 million. 163 in, 1.2 million out. Is that sellable? Without risk? Now, let's talk about fees. There's cost. Michael just showed you the cost. You only put 163 in, and now you die, and your beneficiaries get 381. You could call that double return of premium, right? Will your 401k even come close to delivering for your family like this product? No way. Absolutely no way. Last thing I want to talk to you about is, so we put the application in, we put it through underwriting, the policy gets issued. Policy delivery, you guys, is super important. We go back. Here's your policy. Here's the highlight. You got one just like I do. Here's your draft date. Here's your term. Your family's covered. Now you can cancel your old-fashioned policies. And you do an annual review with that client, and you get more referrals. You guys.
Oh, and Petra, I forgot to mention one thing. They can change their interest allocation date anytime, as many times as they want throughout the life of their policy too.
That's awesome. Which leads up, by the way, to our next speaker. So guys, I just want to end by saying this. We have developed tools in our company that are simple to use. And I guarantee if you use them properly, you'll make 3-4 times more money than the agents that take the quick route, that don't even explain everything to people and get all going to get chargebacks. You're going to get referrals. And don't forget, if license and refer me to people and become a referral agent. Because Bob, when you own this policy, you don't have to sell anybody anything. You just what you did for your family. You get good at this. You're not selling, you're sharing with others. And that's what I love. I hope you can catch my passion here today. Now, our next speaker, we got 2 more speakers. Next one is Ryan Parker. Ryan is our guy at F&G. He's going to go through 20-25 minutes and just kind of show you this new product. And you guys, there's a lot of good products in our industry, but I'm going to tell you this is a special product. It's got a high target. It's got a lot of choices, and I feel really, really good about our future with F&G and this. Ryan, it's all yours. Thanks for being with us. Turning it over to you.
Perfect. Hey, can you hear me loud and clear, Petro?
Can hear you great, Ryan.
All right, perfect. Well, thank you guys for the opportunity to be here. It's a pleasure to be speaking to you today. My name is Ryan Parker. I'm the National Account VP with Fidelity and Guarantee Life, and I've had the pleasure of working with Freedom Equity Group and getting to know you guys over the last, can't believe to say this, but about 4.5, 5 years now. And it's amazing to watch our relationship and our 2 companies grow together over the last 4 years to the point where we're at now, which is really going to take this thing to the next level. If you guys are brand new to Freedom Equity Group and this is kind of your first introduction to this organization, I hope you guys understand how special it is, the kind of training that you guys are receiving from them. There's no other groups out there that do this in-depth and this hands-on of sales training for their agents. You know, they really take ownership of the individuals that join their company and they want to see you succeed. And they give you as many tools as possible to succeed. And there's really no other organization out there that does what Petro and Bill and Bloom and Michael and the whole team do over at FEG. And we're really appreciative of that at Fidelity and Guarantee Life, because we know that we have trained very good personnel out there distributing our products. So we appreciate everything that you guys do. You know, it's a really exciting time at Fidelity and Guarantee Life. And at the back end of the presentation, I'll kind of explain what's going on in our company and all the exciting things happening. But really, the big announcement happened on March 5th, right? We launched the new product, the Synergy Global Advantage Freedom. And there's no confusing it. We named the product after you guys. We really cherish the relationship that we've had with Freedom Equity Group over the last 4.5, 5 years, and all the business that you guys have sent to us and the great partners that you have been. We wanted to thank you guys with that by naming a product after you, and that's why we did this Synergy Global Advantage Freedom as our new product. We really developed this product around what Petro and some of the key leaders over at FEG were telling us. And what they were telling us is that they would like to have a product that performed a little bit better in the income space and in the max accumulation space than what the gold product does, right? So now we have two proprietary products with Freedom Equity Group through Fidelity and Guarantee Life, meaning it's a controlled distribution who has access to this product. And they kind of put that tangibly for you. Fidelity and Guarantee Life, we have about 35,000 contracted agents at our company right now who can distribute our products. Only 2,800 agents have access to the two products we're going to discuss today. So you guys have access to a product very few individuals around the country have access to. Only 2,800 people do. And that allows you to have tools in your arsenal that nobody can come in behind you and sell the same thing. And I think there's tremendous power in that. Well, let's kind of get right into it. So the Synergy Global Advantage Freedom product, I'm just going to call it the Freedom from here on out. So it's kind of a long name. Was built, again, for your max funded, tax-free income, cash accumulation sales. And I think Petro and Michael did an excellent job this morning and today kind of going through those illustrations and showing you where this product really sizzles. And we think it does really well in that marketplace. So for those individuals who are paying $200 to $500, even a couple $1,000s a month, and they're really focused on minimum death benefit, growing as much cash as possible, and being able to take that cash out tax-free to help fund their retirement, right? That's where this product is really designed for. And the key aspect to this product is a unique index. And let's kind of talk about the index that we have. That index is a proprietary Barclays index. So we've actually partnered with Barclays Bank, who I'm sure most of you have heard of before. And Barclays Bank gave us proprietary exclusive distribution rights to this index. And this index is a conservative, volatility-controlled index. And where we're going to get our upside potential from this index is in the participation rate. So it's a no cap, no spread index, and we allow the people who are in this index to participate in 190% of the growth. Okay, I don't know if there's really anything out there like that, right? So there's no cap on the upside. You take no spread away from what's earned, and you get to participate in almost 200% of what is grown, a 190% participation rate. So if the index grows a modest 5% in a given year, your client gets to participate in 190% of that 5%. Meaning they'll get roughly a 10% return in that given year. Okay, so there's unlimited upside potential, and you get that 190% participation rate. And of course, we have higher target premiums in this product than we do on the gold, which Michael did a great job of explaining earlier in the presentation. But let's talk about some of the other index crediting options that we have in this product as well. So we have the fixed index account. Right now, that's running at about 4.5%. But we also have three indexes tied to the S&P 500 in this product. The first is your standard annual point-to-point with 100% participation, and that cap is 15.5%. So when Michael runs those illustrations and you see an 8.26% illustrative rate, that is based on the 15.5% cap. So every insurance carrier has to follow the same guidelines when coming up with their illustrative rates. And those guidelines is you have to take a 65-year look back of the S&P 500, okay, using your annual point-to-point, whatever your cap is. And with ours at a 15.5% cap, that's how we're able to illustrate at 8.26%. When you illustrate the gold, that's around 7.3%, and that's because the cap on the S&P 500 is not quite as large. We also have a 140% participation rate, and that cap is 9%. I get asked a lot, when should you use 140% participation rate? The 140 option is really good in a down year. So if we think the S&P 500 isn't going to perform as well as last year, utilize that 140% participation rate because you'll get more bang for your buck when you probably won't hit that cap of 9%. We also have a monthly point-to-point. That cap is 4%. And the monthly point-to-point is kind of an aggressive, unique index. If you hit the market right, you can really get an outstanding return with the monthly point-to-point because it's basically a monthly sum index, right? So you add every single month's growth over the 12 months, and then whatever that comes back at, you get credited. I'm going to put together a training on the monthly point-to-point just so you guys can kind of see exactly what the upside potential is on that monthly point-to-point. We'll work on that. We also have a Dow Jones Real Estate Index. So for those of you who sold our gold product, it's just like what was on the gold product. So the Dow Jones Real Estate is uncapped with a 1.1% spread. And what that means is whatever the index returns, you minus 1.1%, and that's what you get. So if the Dow Jones comes back at 10, your clients would get a credit of 8.9%. If it came back at 20%, your clients would get 18.9%. So you just minus 1.1 from your return. And then, of course, we have this new proprietary index, which is called the Barclays Trailblazer Sectors 5 Index. It's a mouthful, but it's the Barclays Trailblazer Sectors 5 Index. It's a multi-asset index, similar to what you see with AIG. They have an index just like that, and a couple other carriers have these indexes as well. And really the power of these indexes are they're very conservative, volatility-controlled indexes. And we love the conservative index because we know we're probably going to be able to get a return of anywhere between 3 to 7% on an average year. And when we get that 3 to 7%, the upside potential of that is we get 190% of that 3 to 7%, right? So if it comes back at 5, we're going to get almost a 10% return that year. And I'm going to show you back history to show you over the last 10 years how that Barclays index has performed. But again, the Barclays index is a proprietary index. So I had the pleasure of going to Barclays headquarters in Times Square a couple of months ago and meet the individuals who actually work on this index. So of all the individuals at Barclays Bank that they hire, they have 9 individuals that sole job is to manage this index for us. Okay, so there's 9 people on the desk who manage this index and try to get us the best return as possible. And really what's cool about that is I'm going to show you a little later is there's actually a hotline where you can call and talk to these individuals who are managing this index. And you can learn from them how the index works and what they think. And they'll actually compare other indexes with theirs so you can get an idea as to how it works. We're pretty excited about the Barclays. It's also on our annuity product. So if you like to blend annuities with life sales, it's a very easy transition. So who can you sell this product to? Minimum face amount is going to be $150,000 from the ages of 18 to 45. Our minimum face after the age of 45 is $100,000. And our issue ages are only 18 to 75 on this product. And the reason why is this product is really built for the max accumulation sale, right? And with that, we wanted to make the gold product be more for the juveniles and have some juvenile sales available for the gold product. So this one's only for adults. Our maximum guaranteed variable loan rate is 5% on this product. I want to spend a couple of minutes on this. So we guarantee contractually, and you love to hear insurance companies say contractual guarantee. We contractually guarantee that you will never be charged over 5% on a variable loan rate. There are a couple of carriers out there who I think guarantee a charge of 5%. We guarantee we'll never charge over 5%. So what dictates a variable loan charge? The variable loan charge is based off of Moody's corporate bond rate. And over the last 25 years, the average of the Moody's corporate bond rate is about 7.5%. So based on the 25-year average, you're looking at about a 7.5% charge when taking a variable loan. But with our product, you have that contractual guarantee that you'll never get charged over 5%. And the best part about that is right now we're in a low interest rate environment. So right now, if you were to take out a variable loan, you would only get charged 3.88% with our product. And that gives you great upside potential to have that positive arbitrage and actually make money on the loan that you take out. It's essentially like going into Bank of America and telling Bank of America, I want to take out a $10,000 loan with your bank, but I want you to pay me 2 or 3% interest to do business with you. There's really nothing else like it. And having that cap on the variable loan, one is giving you peace of mind that when they take out those loans, you have a chance to that positive arbitrage. But 2, it's also knowing that your clients can make money on their loans and you have that low cap that you can really utilize. We also have a fixed loan. The fixed loan is a 2% net charge on the first 10 years. Then after the 10th year, it's a wash loan. We do have a 0.25% persistency bonus that starts in the 11th policy year. And again, a floor on all of our indexes. So the floor on all of our indexes is 0.25%. So you'll hear a lot of people say 0, you're a hero. Well, with us, you're going to make a little bit more than 0. You'll make 0.25%. We do have living benefits. So we have 10 critical illness triggers now. In the state of California, you have four triggers. That is going to be changing in the next few months. We're working with the Department of Insurance in California to get those 6 additional triggers included in California as well. Our cap on our living benefits is $1 million, and our terminal illness is less than 24 months to live. And you can see the triggers listed in front of you. We're all working very diligently to beef up our critical illness and our terminal illness and also add a chronic illness to our product. You know, it's kind of amazing. Once we started this relationship with FEG, we really started to understand this living benefits crusade as a company. You guys are kind of the four-founders of that whole philosophy, living benefits, right? It's not death insurance anymore. It's life insurance. It's living insurance and with living benefits. And so we're trying to beef up that living benefits crusade. And I think we're going to be able to do that by, 1, adding a chronic illness by the end of the year. And 2, we're going to continue to beef up that critical illness story as well. But here's that hypothetical look back I was talking about with the different indexes tied to the Freedom product. This is a pretty strong story. So what's neat about our illustrations, and I think most illustrations out there now, is you get provided a 20-year look back chart on those illustrations so that when you talk about the illustrative rates with your clients, you know that you can help paint that picture and help make that illustrative rate believable and conceivable for the client, right? Because what you want to do is you want to under-promise and over-deliver on those illustrations you run. You want to be able to go back to your clients a year from now and say, hey, look, this policy is performing even better than what we talked about a year ago. Let's talk about some referrals and who else do you know that would be able to utilize this type of product. So as you're going kind of left to right, you'll see our S&P 500 with our 15.5% cap and how it's performed over the last 11 years. And this is, again, based on our buy dates. Our buy dates are the 15th of every month. And so what we did is we averaged those buy dates over the last 11 years. The S&P look back is 8.9%. I think anybody would love an average of 8.9% over 11 years, especially when you look at 2008, when the market went down 40% and your clients got 0.25%. That's how we say 0, you're a hero, right? And we have the Dow Jones Real Estate account. That return has been 5.65, not outstanding, but we do have some really good return years like 2014, 19.9%, 2017, 10.79% last year. So we have upside potential with the Dow Jones, and I think it's really prudent that you utilize the Dow Jones Real Estate Index in your sales. And I think it's prudent that you utilize every one of these indexes in your sales with some sort of blend. We also have the Barclays, and this is what I really want to focus on. Look at the Barclays in 2014. There was a 27.19% return your clients would have gotten that year. Last year, your clients would have gotten a 23.37% return. So as I talk about how they're kind of trying to be a conservative index and give us modest returns of 3 to 7%, again, we get 190% of those returns. You can see that there really is significant upside potential with this index, and there's recent data that shows that your clients can really utilize and can really contribute and can really participate in some high returns. And here's what's great. I think on the next slide or in 2 slides, I'm going to show you a website you can go to from Barclays, and they actually update consumer-facing material once a month with how the index is returning. So you can actually follow the index returns, and you can have consumer-facing material that's updated with those returns on a month-by-month basis. But here's an illustration. I'm not going to spend too much time on this because Michael did such a good job of going through the illustrations. But on this one, I just said a 45-year-old preferred non-tobacco male paying $6,000 a year, right, or $500 a month. And he's basically going to pay that till age 70 and take out his tax-free loans. And you can see we project $29,000 of loans going out through age 100. So this does go out to age 100. And on this, the target premium is $5,600. So we've really been able to beef up the target premium on this policy compared to what the gold policy was running at. And I think we've done a pretty good job based on what Michael has shared with me on his comparisons that he's ran with other people in this industry. So this is kind of the story of the product, right? And Michael did such a good job of it earlier. But again, max funded. We want to buy the littlest amount of death benefit for the most amount of premium so we can take out some money tax-free and help supplement our retirement. Okay, but here's the additional resources with the Barclays Index. So the first bullet point is going to be a website that I encourage all of you to go to. It's trailblazer.com/index. index.barclays.com. This is a Barclays website. They have a website just for this index, and you'll be able to actually, again, get consumer-facing material that you can utilize at the point of sale if you want to, and you can actually go there and just educate yourself about the index even more if you want to. There's also a hotline that you will see listed. This is a direct line to the individuals who are working on and managing this index. And they're going to answer the phone, and they're going to answer whatever questions you have about the index. And they'll even talk to your clients as well if you want them to. And we also created a website of our own. It's synergy.fglife.com. As you guys know, you're part of a proprietary distribution channel with Fidelity and Guarantee Life. And what that provides for you is, one, you get two products that nobody else can sell, right? The gold product and the freedom product. But with that, nobody else can sell it, so we can't put those products on our website. So what we did is we created another website just for you guys that's consumer-facing with all of our consumer material and going over both products, so you can send your clients there, and you can also send your new agents there to learn about both products. So we like that website quite a bit. Let's kind of move on. So I did want to talk about the gold product. So you guys no longer just have a proprietary product. You guys now have a proprietary product line. And what that means is you have two products now that work different from one another for two different types of clients. And where the gold product is now positioned is really as a term alternative, low-cost death benefit IUL with cash accumulation. You know, get more death benefit for the same money. That's the story with the gold product. With a traditional IUL, you think about it, you want to buy the smallest amount of death benefit for the most amount of money, just like with the freedom product. With the gold product, we're looking more like a death benefit type of sale, or maybe minimum funding it, trying to get a $250,000 death benefit to cover burial costs, to cover any kind of financial burden that could be left with the family. That's really where the gold product is going to fit into your sales. And we have 2 years to collect first-year target premium on the gold. Sell it once, get paid on it twice, and I'll explain to you how that works when I show an illustration next. We do have non-med underwriting with the gold. That is 0 to 45, and then 50,000 to 149,999. That's just on the gold product. On both products, we have what we call accelerated underwriting. I'm sure you're used to that. Some of the other carriers you do business with, we go up to age 50, up to the death benefit of $1 million. You're going to allow our underwriters to do a first look. And right now, about 26% of our applicants are qualifying for accelerated underwriting, meaning they would get issue paid, preferred non-tobacco or standard non-tobacco without your paramed, blood work, or HOS. For those that don't qualify for that program, at that point in time, you would order the paramed and they'd go through full underwriting. And again, the gold product, we have that gold commodity index, which is such a great hedge to the S&P 500, and that's still the story with the gold product. But let's just look at a quick illustration with the gold. Again, it's into your low-cost death benefit IUL. We're minimum funding to target funding these policies. Okay, for this client who's 45 years old, he just did a $1,200 a year premium for $150,000 of death benefit. And the cool part is the target premium is $1,900 on it. So depending on what your contract level is, you get paid off of that first commission of $1,200, first year premium of $1,200, and in the second year, you would actually get paid off of the additional $700 that it takes to get your first year target premium. So that's why I say sell it once, get paid on it twice. It's a pretty good feature, especially for this type of product where you're going to be minimum funding the target funding of those policies. But that's kind of it for the products. I do want to give a quick corporate update. You know, Petro talks really well about kind of all the stuff that we've done at our company to continue to earn your business. You know, we got a saying at Fidelity and Guarantee Life, and I'm sure a lot of you have heard this, is we don't expect your business, we expect to earn your business. And how do we earn your business? Well, one is by giving you competitive products, and two is by continuing to enhance the experience you have with Fidelity and Guarantee Life, and three is it's by issuing policies that get in the door as fast as possible. So service you can count on. With the Freedom Equity Group, I'm proud to say that you guys submitted over 10,000 applications to Fidelity and Guarantee Life last year. 10,000 applications. That's an outstanding amount of families that have been protected by you guys just through the Fidelity and Guarantee Life relationship. And what's even greater about that is that we were able to issue pay over 9,300 of those policies, putting us at about a 93.6% issue pay ratio last year with Freedom Equity Group business. I think if you talk to the leaders, they typically say that a 70 to 75% issue pay ratio is very good and competitive. We were at 93.6%. And all that credit does not go to us. So most of that goes to you guys. That means that you're submitting good, clean business to us, and we can get issue paid as fast as possible. So we're very proud of that. And really, What's allowed us to hit those numbers is we have dedicated case managers just for Freedom Equity Group. So internally, we have 17 people now who work on our case management desk. 9 of those individuals solely work on your business to get your business issue paid. So when Katie Carroll and the whole team over at FEG or even your back office calls Fidelity and Guarantee Life, they're now getting familiar faces who understand your business and who are working on your policies every day to get an issue paid. Those people are Fidelity and Guarantee Life employees, and they are incentivized to get your policies issue paid as fast as possible. That's a big change we made last year. We also have new ownership. We finally completed our sale to a company called CF Corp, who is now FGL Holdings. What really is the tangible impact that you're going to see on this new ownership is, one, all of our senior executive team is staying intact. And 2 is that we want to be an aggressive, growing company. Our goal is in the next 3 years is to grow from a $1.5 billion annuity company to a $3 billion annuity company. And we want to grow from a $50 million IUL company to a $100 million IUL company. We want to take on the Transamericas of the world with the IULs. And we're going to do that through strong distribution partners like Freedom Equity Group and helping you guys grow through competitive products. Okay. And the number 3 thing that we're going to see from this new ownership group is improved ratings. As most of you on this call know, we are a B++ rated company. And we've been fighting for years with AM Best to give us our A rating back because our financials are very strong. And what they kept telling us is that because of our previous ownership group not being that highly rated, we can't improve your ratings above a B++. And so the day our sale closed in November, S&P 500 raised us 3 points to investment grade. And what's awesome is AM Best came back, I believe, a week and a half ago, and they told us that F&G, we no longer look at your ratings outlook as neutral. We now put you as a positive outlook on our ratings, which means that we are now looking at a ratings increase within the next 12 months. And that was a press release that AM Best sent out regarding our company. And that's probably one of the most exciting things that's happened to our company in the last 4 or 5 years. We're looking at finally getting that A rating back by the end of the year. And that's going to have a great impact on all of us. And we are, again, we're beefing up that living benefits story. We're having calls almost weekly on chronic illness and how we can get that out and into our policies as fast as possible by the end of the year. We have an online client portal coming in April. And what that's going to allow is your clients to actually log into a consumer webpage and track the policies that they own with Fidelity and Guarantee Life. So they can look at the cash value, the death benefit, any annuities that they have. They can look at all that, and they can look at that growing in real time. And hopefully what that's going to allow is for them to call you and ask you questions about their policy and hopefully give you even more referrals. We also have e-delivery. E-delivery is coming out this fall, where you're going to actually be able to email deliver your policies to your clients. So we're pretty excited about that. That'll be by the end of the year. And the last one is we got much, much more coming, right? We're continuing to beef up the gold product as well. So we got this new Freedom product that's really sizzling. We want to continue to make the gold product as valuable as possible to your distribution. So we're going to continue to beef up that story. We're going to continue to beef up our digital enhancements as well and continue to improve that experience that you have with Fidelity and Guarantee Life. So I'll just leave it with this. Thank you guys very much for allowing me to speak to you today. You know, it's always a tremendous honor to be able to speak to Freedom Equity Group. We appreciate everything that you guys have done for us over the last 4.5, 5 years. There's no question that our company would not be where we are today without the partnership that we've had with you guys. Through the good and the bad, you guys have always been very transparent with us about where we need to improve, where we can get better, and hopefully we can continue to see this thing grow, and hopefully we can take on and break new records, because based on the first 2 months of premium and applications you guys have sent us, we are on pace to put you guys currently are our #1 marketing organization in 2018. You guys have already submitted over, I want to say 2,600 applications in the first 2 months with Fidelity and Guarantee Life, so we much appreciate that. And we actually hired 2 more case managers for you guys with the expected increase in business. So Petro and Michael and Bill and the whole team and Bloom, we appreciate everything. We're looking forward to a great 2018.
All right, Ryan, fantastic job. 2,600 applications so far this year. That's pretty darn exciting. All we got to do is double and triple that number, and we'll all be really happy. So, guys, thanks again, Ryan. We got some exciting things happening here at Freedom Equity Group. To kind of wrap up today, so that's good news. Great job to all of our speakers. Our last speaker today has been a friend of mine for 25 years. He's the guy that taught me living benefits. When first saw living benefits, I honestly thought it was a gimmick to sell life insurance. Didn't understand there was a crusade. I just didn't get it. But now I do, and it changed my life. So I asked Dave Weiner, many call him the insurance genius. I asked Dave to kind of end the call and talk to us a little bit about the size of our marketplace. What are we dealing with here? How big is our future? And what can we all, because remember one thing, we have this thing called equity share. We build this thing good enough and strong enough, we got a chance with our $100,000 earners to cash in someday. That's the ultimate goal. So anyway, Dave, welcome to the call, and you're our last speaker. So share with us the opportunity that you see.
Thank you, Petro, and everybody. You did a great job, Brian. Outstanding, taking F&G from where it was to where you are now and where you're heading. What a great story. I mean, it continues to get better. We do follow you now on the stock market, and we watched that entire transition, and we think that we're glad to have you as a partner with us in Freedom Equity Group. So I just wanted to do my kudos on that. We look forward to having you come out and visit us in the Midwest sometime in the future. But with that said, I want to take us on a timeline history, because this is what we all have to do. I want to talk about the size of this marketplace and the attitudes and perceptions of the life insurance industry. You got to understand, for the last 4 decades, the insurance industry has embraced the most profitable concept known to them. And they don't want to change that, because most of the insurance companies are driven to make profitability, and they're Wall Street entities. And one of the products that's been driven so much in the last 4 decades was and is term life insurance. And term life insurance was not the choice of the life insurance industry back in the 1970s. And thanks to Steve Little giving me a call the other day, he didn't even realize he gave me some new bullet points for one of my speeches. And Steve, I got to thank you for the kudos, because I was not aware of the amount that you guys were doing in face amount back then. So I want to go into history here. I'm not gonna go forever and ever, but I just want you to understand something. The new type of life insurance was created long ago, and it wasn't introduced into the world to 23 years ago. 23 years ago, it made the shores of the United Kingdom, and it was created by Dr. Marius Bernard. Now, he and his brother Christian, they did the first human-to-human heart transplant back in December of '67. And what they did were miracles. They prolonged life. And the technology that they started way back when that was saving lives was destroying them financially. Dr. Bernard helped create the very first critical illness contract, and it was introduced 23 years ago. And by the way, in the first 3 years, the Brits, the South Africans, all the people that were part of the United Kingdom, they embraced that new stuff. They spent out of pocket $45 billion in premiums, not face amount, premium, to get that new type of life insurance. And today in the UK, whether you're borrowing money as a businessman, whether you're borrowing money as a consumer to get a residential mortgage, if you cannot secure this new type of life insurance, they're not going to probably give you a loan. They want this insurance in place. Now, it was introduced 20 years ago in Japan, Australia, Canada, and America. And the Japanese, boy, they fell the first year out of the gate. 1 in 4 households got the new type of insurance. LIMRA, which you use to take your AMLs and all your other, certificate stuff that you physically do. I mean, LIMRA, that is the backbone of research in the insurance industry, stated back then that they felt the Americans would spend in the first 3 years. This was their projection, $70 billion in life insurance premium. And by the way, this didn't happen. It just did not occur to that nature. We're 20 years in since it was introduced on the shores of America. And 20 years later, 99.5% of the policies in force, now there's 149 million contracts in America, 99.5% of those contracts, folks, is the stuff that does not pay the life insurance death benefit up front. I know earlier in the meeting they were talking about term life with Michael St. Clair, and we represent a couple of the companies out there that do term with living benefits. We represent American National. We represent AIG. Do you realize a company like Prudential that charges 18% more does not do living benefits on term? North American Life does not do living benefits on term. Mutual of Omaha doesn't do it. The number one seller of term life insurance in America, Primerica, does not do it. Why? Why don't they play? Why won't they jump into this game? And it's because no one has forced their hand to make a change. No one has made it tough. No one's done enough nasties, as Steve Little would say. You got to get out there and do the nasties. Well, you got to. We have to use what we know. And folks, one of the things that the company that Bloom and Petro and Steve Little came from was A.L. Williams. And way back when Art first got in the business back in 1970, he had his own preconceived notions. He thought that the life insurance industry was trash. Well, the insurance industry has never been your friend. Never. Back then in the 1970s, only 10% of the permanent life insurance contracts that were being bought in this country ended up becoming a claim. And they were scared to death of term life insurance. In fact, they mocked and ridiculed those first termites. They laughed at them. And they said, no, we don't. They didn't know what it was. All they knew was that, for the same amount of money, you went from $10,000 of life insurance back then to $150,000 at risk. And the insurance industry was terrified of that. They thought, oh my God, we're actually going to have to pay tons of claims. And like I said, Steve Little corrected something. I knew in 1977 when Art started his official A.L. Williams agency, he had gone and built a sales force with a core group of 85 people. And I knew by 1982 they had gone to over 200,000. They only beat Prudential that year. They did $38 billion in face amount. That's astronomical amount of life insurance back in a day when the face amounts weren't as big as they are today. I would say their average face amount was 150, maybe 100,000, 200,000, not the millions that we do today. And when they beat State Farm, Prudential, New York Life, and MetLife in 1984, and they wrote $95 billion, I got to get you guys to understand something. I got to get you to understand what the average claims ratio is of a company. And folks, as I grab this statistics here in front of you, and I grab this overview from one of the companies that paid out in the UK $1 billion in claims from 2010 to 2014, this is one carrier, and they didn't do anywhere near the amount of productivity that a Primerica's done in America the last 4 decades. And as I pop over here to the next page, I just want to point out one thing. This company in 5 years paid out $1 billion in claims. And there's only 2 key statistics here. Number one, the average age of a claim there was 45 years of age. The average length of time a policy was on the books for that company was 8 years. And by the way, they did not do term. They were doing permanent life insurance contracts. I want you to pay attention to that. 8 years, 45 years of age. Think about that for a second. And they did $1 billion in claims. This is out of their claims report. In America in 1984, they did $95 billion in face amount in 1 year. And no, they weren't doing living benefits back then. They were just doing term life insurance. But here we are, 1984 to 2018, 34 years later. Do they do the same amount of face amount? Probably darn tootin' close, because face amounts are bigger. And I want you to close your eyes for just 1 second. It's not just them, it's every one of them. Whether it's a permanent product without living benefits, whether it's a term policy without it, $95 billion. 8 years from now, in play. What would the acceleration be of that? 60, 70 billion in claims that are not going to happen because Americans got sowed down the drain with the wrong stuff? Because the agents weren't educated to know how to do the right thing? How many hundreds of billions of face amount is being put on the books? And we know what the ratio of claims is on term. The reason the insurance industry embraced the new stuff 4 decades ago is they finally realized Art Williams was a genius, but not a genius for the consumer. They realized he was a genius to their pocketbook, to their bottom line. This guy handed them the keys to the kingdom for the last 4 decades. We took a claims ratio from 10% to under 2%. And if you're doing 100 billion in face a year, oh my God, that's less than 2 billion in claims. Even on that 95 billion, that's only 1.8 billion. 1.8 billion instead of being 60 or 70. Who's responsible? Well, we can honestly say the insurance companies are, can't we? We can say Prudential's responsible. We can say Citigroup and Primerica's responsible. They knew when the stuff got here. They sat, they looked at it, and they said, no, we're not willing to do it. Art Williams had a mantra. We were going to destroy MetLife. We were going to destroy New York Life. We were going to take on Prudential. And all those big ivory tower companies at first were scared to death of the young lad. And because they didn't know that what he was doing was going to better them. They built chassis like Universal Life, which is, by the way, term life insurance with cash. The insurance industry adopted everything that Art said to do. They did it. And they love it. Oh my God, do they love it. And people still cash out their contracts early. People still quit early. And the number one reason is because the average age of a claim in America is 43 years of age. 52% of those onset claims are between 41 and 50, and you have a choice as an agent here, as a builder here. You see, you've got to take on the process that Art did. You have to understand, you can't get it done at 500 agents or 1,000 agents. You got to understand the numbers have to become different. You got to have a change in mindset. Do you realize that if we got to 8,000 sales a month, that's 2,000 sales a week. And even if I used a figure of $2,400 in life insurance target commissionable premium, that would be an extraordinary 240 million in sales. Extraordinary, because that would be almost a 1,000% increase for us. I mean, just night and day from where we are. And the reality is, you still have to give that performance a flunking grade of an F. Because when you divide 100,000 sales into the 149 million contracts in this country, that is 0.1%. The only way we get to make this change is to basically put on our big boy pants like they did in the 70s and 80s. And you bring on the masses. And you find those in-force contracts. And you disturb that person. You disturb them with simple conversation. Simple. You know, it's not that difficult. You got to take a minute or 2 minutes with each person, and you ask them, do you own life insurance? And they say, yes, I do. I am certain the reason you have life insurance is got to be to protect your family. I want you to pretend for just a second it's 30 days from now. Just 30 days from now. And I want you to imagine it was a horrible day, not the worst day of your life, but pretty darn tootin' close. That you suffered a heart attack and you're not dead, but you had a heart attack. You're going to live. You're going to get better. I just have 2 questions for you. Would it be okay? Would it be okay if we brought your life insurance money to you so that you'd have money while you're recuperating, getting better, and having your income? Folks, that's a big deal. Would it be okay if we got the insurance company to notify you you no longer had to make a payment? You see, when you design the new type of insurance today, you can design it to do 2 things. 2 things, folks, 2 things. A, pay off all your debts the day you suffer a horrific illness. And if we do our jobs right, have enough death benefit to go back to the life insurance company and replace their income 100 cents on the dollar, giving them choices, giving them control of their life. And if they do recover, the fact that their income is replaced, maybe they don't have to go back to work. And if they do succumb to their illness or their injuries, to be able to reroute that income till their spouse takes his or her last breath. That's why the life insurance industry was scared to death of this new product. But this product exists on the American shores. We represent it and we advocate for it. And folks, it is up to you to do the job of bringing people into this company to make sure that the 149 million policies start to shake. It's time for you to take it to the ivories, to those ivory towers, just like Art did. We can force a change. He went from 85 to 200,000 people in less than 5 years. We care. And it is up to you, each and every one of you, to take on the challenge. That's how big our marketplace is. It's bigger than anything you can humanly imagine, and it's yours for the taking. With that, I want to thank all of you for participating in today's IUL University. I give it back to my dear friend Ron Petrinovich, and thank you for letting me have a few words.
All right, David, inspired the heck out of me. 2,000 sales a week, and we hit 0.1% of our market. So David, thank you so much. Thanks to all the speakers. Fantastic job. Thank you, all the participants, for spending this time with us. I just want to urge you to, we're at a special place at a special time. Take advantage of the moment. Just do this. Go tell the story. Duplicate yourself. Be a leader. And change the future. Live free. Thanks so much, everybody. Great job. Bye-bye.